Welcome to The Explainer. Today, we're cutting right through the noise to examine the absolute foundations of finance. Look, whether you're navigating massive corporate markets or just trying to optimize your own personal portfolio, the underlying mechanics remain exactly the same. So let's dive right into the core concepts driving the entire financial system.
Here's our roadmap for today. We'll start with the pillars of finance, move right into the financial ecosystem, check out money and central banks, break down the cost of money, and wrap it all up with the time value of money. Let's get into it.
All right, Section 1, the pillars of finance. At its absolute core, finance is just the study of acquiring and investing cash to maximize value. If you strip away all that confusing Wall Street jargon, it really just comes down to the constant monetary choices we make to optimize our wealth. How funds are acquired, how they're spent, how they're managed. Literally, every single decision has a distinct financial implication.
Think of this whole landscape as being built on three overlapping pillars. First, you've got institutions and markets. That's the environment where capital actually moves around. Then you have investments, which is all about the growth of individual financial assets. And finally, financial management, which directs how a business raises and utilizes its funds. And these absolutely do not operate in isolation. A decision made in some corporate boardroom immediately ripples through the investments of everyday individuals and the institutions that tie them all together. Which brings us to a foundational principle you've definitely heard before: cash is king. Look, in an environment defined by uncertainty, liquid cash is what gives you ultimate flexibility. A firm might boast about having massive fixed assets, but if a fleeting high-yield opportunity pops up and they don't have cash on hand, those fixed assets mean practically nothing. Cash is, quite simply, strategic power. Moving right along to Section 2, the financial ecosystem. So, this massive global network that facilitates the transfer of wealth, it operates primarily in three arenas. First up, securities markets. These are the forums for trading debt and equity. Think stocks and bonds. Next, derivative markets. These actually bypass the asset itself, trading contracts whose value is derived from underlying assets, like commodities. And finally, the foreign exchange, or Forex. This is where institutions trade global currencies, which is essentially the foundational plumbing of the whole international system. Now, zooming in on securities for a second, there's a definitive dividing line based entirely on time. On one side, we have money markets. These are the short-term arenas for securities maturing in under 1 year, like treasury bills. These are all about prioritizing immediate liquidity. On the other side, capital markets. This is the long game. We're talking the domain of stocks and long-term bonds where capital is parked for extended structural growth. All right, Section 3, money and central banks. Okay, this outlines a seriously fascinating mechanism, how the banking system structurally expands the actual money supply. Let's say a person deposits 1,000 euros into a bank. With a 10% reserve requirement, that bank legally holds on to 100 euros and lends out the remaining 900. Well, that 900 gets spent and then deposited into a second bank, which holds on to 90 euros and lends out 810. This cycle systematically repeats itself until that initial 1,000 euro deposit balloons into 10,000 euros of total money supply. It's an exponential multiplier, and it's controlled entirely by central bank reserve requirements. Now, because controlling this money supply is so massively impactful, it fuels a major economic debate. On one hand, you have the monetarist view, which basically argues that managing the money supply itself is the primary driver of economic output and inflation. Conversely, you've got the Keynesian view. This perspective argues that private sector volatility requires active government intervention through fiscal policy, things like targeted spending and taxes, to really stabilize output. It's a classic debate of monetary mechanics versus fiscal intervention. Which naturally leads us to Section 4, the cost of money. Consider for a moment what actually happens when you lend capital. Having cash in hand today offers immediate utility, right? You have the ability to consume or invest right now. Lending that money means giving up that flexibility and postponing your own consumption. So, what exactly is the calculable cost of making someone wait? The answer to that is interest. Honestly, it really helps to think of interest simply as rent. Just as a tenant pays to temporarily occupy an apartment, a borrower pays a lender to temporarily occupy their capital. A savings account, that's just a bank paying you rent to use your money. A mortgage, that's you paying rent for the privilege of using theirs. And here's the thing, a nominal interest rate isn't just some arbitrary number pulled out of thin air. It is a carefully calculated stack of premiums. It starts at the bottom with the real rate of interest. That's your baseline cost. Added to that is an inflation premium, which protects your purchasing power. Then, a default risk premium compensates the lender just in case of non-payment. After that, a maturity risk premium accounts for the uncertainty of a long timeline, and finally, a liquidity premium is slapped on top if the underlying asset is hard to sell quickly. That entire stack, that dictates the final rate you see.
All right, final stretch, Section 5, time value of money. The foundational rule of all finance is incredibly straightforward. A euro today is inherently worth more than a euro tomorrow. Having capital today means it can be invested to earn interest and grow. Waiting a year for that same euro means forfeiting a whole year of potential growth, while inflation simultaneously eats away at its purchasing power. Literally, mathematically, time is money. And when we measure how that money grows, the specific mechanics really matter. Simple interest yields returns only on the initial principal. It's a linear, steady climb. But compound interest, that actually reinvests the returns. You earn interest on the principal, and then you earn interest on your previously earned interest. This creates this accelerating upward curve. It is the absolute mathematical engine behind exponential wealth creation. To quickly gauge the real power of compounding, you can use the rule of 72 as a super practical mental model. Just divide the number 72 by your annual interest rate, and you'll find the exact number of years it takes for an investment to double. So if you're yielding an 8% return, 72 divided by 8 is 9. That means your capital doubles every 9 years, entirely on its own. Pretty amazing, right? Look, we operate inside this financial ecosystem every single day. We navigate money supplies, fluctuating interest rates, and the relentless march of time. So the ultimate question I want to leave you with is this. Are your daily monetary choices actively harnessing compound interest to maximize your own future wealth, or are you simply paying rent to maximize someone else's? The mechanics are crystal clear. How you utilize them is entirely up to you. Thanks so much for joining this explainer, and we'll catch you next time.